Hey everyone, welcome back to Corporate Decoder, the place where we dive deep into the financial world to uncover the real story behind the numbers. And today we're going to decode a very interesting document from Manulife Gaia, trust their registration statement and private placement memorandum. This is not your average company report, but it tells us a lot about how certain investment funds operate behind the scenes. Imagine a very exclusive club for investors where the doors are kept pretty tight and the rules are quite specific. This is essentially what Manulife Gaia Trust is all about. They are a registered closed-end fund, but they operate very much like a private investment fund as well, meaning shares are sold privately to specific types of investors, and they come with restrictions on transferability. This document is a registration statement filed with the US Securities and Exchange Commission, or the SEC, and it is primarily about how Manulife Gaia Trust, that is the fund or the trust itself, is registered as a closed-end, non-diversified management investment company. They officially became registered on the 12th of February 2026. The fund is managed by Manulife Investment Management Private Markets US LLC, which we'll just call the advisor. A key thing to understand is that although this is a registered fund, the shares are not being sold to the general public. Instead, they are offered only to specific investors who qualify as accredited investors or non. Use persons and these investors need to demonstrate they are also qualified clients, meaning they have a certain amount of money to invest. So what is this fund actually doing? Their main goal is to generate current income, and under normal market conditions, they plan to invest primarily in senior loans. Think of senior loans as debt that companies take on to finance their operations. These are typically first or second lien loans, which means they are a priority for repayment. The fund will invest in loans that are below investment grade, which is a fancier way of saying they are considered riskier, but potentially offer higher returns. They are not looking at commercial mortgage loans, but rather corporate loans. Now, let us get to the fees and expenses. This is where things get really interesting for investors. The fund will pay its advisor a management fee of 0.55% annually of the average net assets. This fee is charged regardless of how the fund performs. Then there is the performance fee. This fee is quite complex. The fund will pay the advisor a performance fee of 10% of the fund's net profits. However, there is a catch, and a big one. This fee is only paid if certain targets are met, and crucially, if the fund's net profits after deducting this performance fee still meet a specific preferred return. Also, there is a high watermark, which means any past losses must be recovered before any performance fee can be paid. So while there is a potential for a performance fee, its payment is heavily guarded by performance conditions. When you add it all up, the total annual operating expenses for the fund are listed as 1.20% of net assets. This might seem small, but over time it adds up. They even provide an example to illustrate the cost for investors. On a $1,000 investment assuming a 5% annual return and the total annual expenses of 1.20%, an investor could expect to pay around $145 in total expenses over 10 years. That is not a prediction of performance, but a regulatory requirement. Of course, with any investment, especially one focused on below investment grade senior loans, there are significant risks. The document details a whole section on risk factors, and it is quite extensive. They warn about greater levels of credit risk, meaning borrowers might not pay back their loans. There is also call or prepayment risk, where if interest rates fall, borrowers might pay back loans early, forcing the fund to reinvest at lower rates. Liquidity risk is also a big concern because these are not publicly traded securities. They can be hard to sell quickly without losing value. Indeed, the fund deals with illiquid and restricted securities. This means they cannot be easily sold on short notice. This can make it difficult to value the fund's assets accurately, and it poses a risk if the fund needs to raise cash quickly. Manulife Gaia Trust is also a non-diversified fund. This means it can invest a large portion of its assets in a small number of issuers. While this can lead to higher returns if things go well, it also significantly increases risk if those few investments perform poorly. A key goal for this fund is to qualify and be treated as a regulated investment company, or a RIC. This is important because it generally lets the fund avoid paying corporate income tax as long as it distributes most of its income to shareholders. However, the fund warns that there is no guarantee it will qualify or maintain RIC status. Failure to do so would mean the fund would be taxed at corporate rates, which can significantly reduce returns for investors. A particular challenge they mention is that the fund may recognize income before receiving the cash for it, such as original issue discount or payment in kind interest. This can create difficulties in meeting the distribution requirements to maintain RIC status. The fund's board of trustees oversees the entire operation. They have delegated the day-to-day management and investment authority to the advisor. The board is structured with a majority of independent trustees, which is a good sign in terms of corporate governance. We see the names of the trustees and their backgrounds. Hassel H. McClellan, for example, a trustee and chairperson of the board, has a background as a former professor of finance and policy and director experience with various entities. Then there is Ian Roke, a non-independent trustee and president, who also serves as global head of asset liability management for Manulife. His experience with managing financial risks is significant. The fund's portfolio turnover is expected to vary from year to year. They do not anticipate engaging in short-term trading strategies under normal circumstances, but securities may be sold when investment considerations warrant it. As of the 12th of February 2026, the fund had not yet commenced operations, so there is no portfolio turnover to report yet. Looking at this filing, we can see a picture of a specialized investment vehicle designed for a specific type of investor, the focus on senior loans and below investment. Grade debt highlights a strategy aimed at generating income with a higher risk profile. The management fees are in line with industry standards for such funds, but the performance fee structure has conditions that protect investors from paying fees on underperformance. The extensive risk disclosures are a clear indicator of the speculative nature of these investments. The fund's intention to qualify as a RIC is crucial for tax efficiency, but the challenges in achieving and maintaining this status are explicitly mentioned. Structurally, the fund appears sound with an independent board overseeing the advisor. However, the core investment strategy itself carries inherent risks due to the nature of lower-rated debt and the illiquid markets they trade in. The non-diversified nature of the fund further amplifies these risks. For an investor who understands and can tolerate these risks, this structure might offer potential for higher income. But for the average investor, this is certainly not a product for the faint of heart. The complexities in qualifying for RIC status and managing cash flow for distributions are notable points to watch. Alright, that is our breakdown of Manulife Gaia Trust's registration statement. What is your take on these numbers and what they signal for the company's future? Do you think the exclusive nature of this fund is a good thing for managing risk, or does it just keep potential investors out? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives into corporate finance. Don't forget to check out the Discord in the description for more discussions and community insights. Thanks for watching. See you next time.